Hello, everyone. Hey, hi there. Welcome. It's Ed Ponsi here on behalf of FX Street. Good to see you. Good to be here. Let's begin. Plenty to discuss, but if you have any questions or comments, do please refer them to me, um, and we can discuss anything. It can be anything regarding technical analysis or fundamental analysis. We can talk about risk management. We can discuss any aspect of trading that you would like to discuss is fair for discussion. Um, so feel free to ask away, and we will begin. We're going to talk about the trade balance numbers overnight to start to kick us off here. Um, some pretty good numbers, well, mixed numbers, let's just say, out of China overnight, because the export numbers were a little bit disappointing, right? You're looking for 10.9, you get 7.2. The exports disappointing. Um, Imports also disappointing on a year-over-year basis. Looking for 16.6, you get 11.0. But still, exports are outpacing imports, so you end up with a trade balance that is positive, a trade surplus. Um, right? So that's good news. You get a trade surplus year over year and month over month, right? And better than expected in both cases. I think the interesting thing, though, if you look at the month over month numbers, exports were up 11.2% and imports were up 14.7%. So I'm looking at that import number and I'm thinking, okay, when China imports, from whom do they import? I think you would have to say Australia. So if I look at the Australian dollar, are we going to see a green candle? Drum roll, please. The answer is yes. Big green candle on Australian dollar. Should not come as a surprise. Okay, so we connect the dots here, right? The we have China importing and more than expected, and really 14.7% increase in imports in China on the back of a 23% increase the prior month. So a lot of imports in China, and we know that one of China's biggest trading partners is Australia. So a big green candle for Australia right there. Uh, Thanks in part due to those numbers from China. So nice work, Australia, and nice work, China. And so not a big surprise there when you see good numbers out of China on imports. We see good news for Australian dollar. And you look at Germany now. Germany exports down 2.8%, imports down 4.5%. So listen, this is worse than expected on both ends. But and we said yesterday, industrial production was worse than expected, and now exports are worse than expected. Well, those two things go hand in hand, right? Exports are created in factories, and that's what industrial production is: industry, production, right? Factory production, industrial production. So, and Germany's exports come from factories. Germany does not export coal or oil, in any meaningful degree. Germany exports precision equipment, high performance automobiles, um, laboratory equipment, CAT scan devices, things that you see in hospitals, right? Hospital equipment. Um, those are the things that come from Germany to a great degree. And so exports are down, and industrial production is also down. Trade balance was slightly positive though for June. guess because imports were down more than exports. None of this really seemed to bother the euro too much, but you'll notice the euro did not quite look as bullish, not quite as big of a candle there on the euro as we saw on the Aussie, right? But look at that moving average, that wonderful moving average and all that bounceability on the moving average. So let's set it up and let's start moving. We need to start moving our stop here. Now the initial entry is on the moving average at 117.52. That's right here. And the stop would be half of the ATR on that day, right? On that particular day. Now that day, the ATR was 100 pips, so the stop was 50 pips lower. Well, that's pretty easy. 117.52 minus 50 was 117.02. And that's the initial stop on the day of the entry. What the heck is going on here? Okay, the next day, right, when this candle closes, yesterday's candle closes, we can move the stop. On that day, the moving average is 117.60, and the ATR is 96 pips. Half of 96 is 48. So 60, that's the moving average, minus 48, that's half of the ATR, equals 12. So the stop goes up from 107.02 to 107.12. And that's where it sits right now. 117.12, I'm sorry. So the initial risk was 50 pips, and now the risk is 40 pips. And we know we're not stopped out because the price has not even touched the moving average since the day of the entry. So we know that the trade continues. Right now, the price is 117.11. That's 60 pips above the entry price. So we're up 60 pips on the trade with a risk of 40. Keep in mind, we can close half of the trade anytime that we like, with the caveat that you must continue the other half of the trade as specified, just trailing the stop under the moving average by half of the ATR. That's how we roll. Okay. And this teaches us discipline. It also teaches us that if we simply do what we believe is right, in some cases that will end up being the right thing, but in many cases it will end up taking you out of the trade too soon. And once you realize this, it'll teach you to relax and just stay with the trade when it's going in your favor. We never relax and stay with the trade when it's going against us, of course. That would be a bad move. But if it's going in your favor, let it roll. Right? That's the idea. Mark has a question here. If you don't have a position, would you jump in here with a 50 pip stop because you have a buy signal most recently? Or would you wait when it comes back to the moving average? It's a good question. Right now, the entry is the moving average. So if you jump in here, you're chasing. And that would be poor discipline, bad trading, in my opinion. You'd be entering in the wrong place. If the whole idea here is that the moving average is acting as support, right? So if you jumped in here with a 50 pip stop, your stop would be above the moving average. Your stop would be above support. So it would defeat the entire purpose of the strategy. So no, I would definitely not do that. It's a good question, though. It's a fair question. But that's not how I would do this, no. Very good question, though. And that's, when it comes to any strategy, my opinion is it's like fishing, right? We have to, it might not be, we all want to catch the fish, right? But in our anxiety to catch the fish, what's the best way to catch the fish? Should we run into the water and pursue the fish? It's not going to work, right? Rarely will that work. I mean, I've had a fish jump into my boat. Okay, so anything might work on a random occasion. But generally speaking, you've got to wait for the fish to come to you. Fair enough? And that's what I'm saying. We have to wait for the fish to come to us. Great question, though. Okay, let's continue on. So that's our setup, and the setup occurred on the day of non-farm payroll, but the entry was after the non-farm payroll report. In fact, I think it was over an hour after the report hit. I don't like to trade the event itself, and I like to give it a little bit of time for the dust to clear. But the actual entry here occurs, I believe, over an hour after the actual news hits. So I believe it gave time for the dust to settle here. Okay, let's move on. And another point here I'd like to make before I move on, one last thought here, is this. Eventually this stop, if this continues to move higher, eventually the stop will be over the entry point. At that point, if the stop goes above the entry point, then there would be no risk in the trade, right? Or virtually no risk in the trade. And at that point, if a trader wanted to add to the position, let's say the price then comes back to the moving average. If a trader wanted to add at that point, it's okay to do that. It's not mandatory, but that's something that a trader can do. That can add to this position and sort of build the position larger if that's something that the trader wants to do. It's optional. Okay, it's not mandatory. All right, let's move on now. Yesterday we were talking about the British pound and how this was one of the weaker currencies out there. You can see Aussie had a nice bounce up on that Chinese data. Euro had a nice bounce up. Where's the bounce for British pound? There is no bounce here. And we were talking yesterday, and we had a discussion here with Carlos was in the room, one of our students, and one of the traders. I shouldn't even say students, just one of the traders who frequents this room, because this is really just a room of traders. And he was talking about shorting this, and really, you've got to say, it breaks the trend line, right? It came down with such force and velocity, unlike other currency pairs. There was really vicious selling here, whereas we just did not see that on the other pairs. We did not see that on the other major pairs. But just vicious selling, broken trend line. Technically, I stated that, look, you don't have a lower high yet. You need to get under this dotted line to officially get the lower high. But Carlos was saying, look, if I can get on the hourly an oversold RSI, it might be worth a shot to take a short on this one. And that's beginning to look like I wanted to give this a little bit of time to settle in, but this is beginning to look like a better and better idea, because you look at the way the other currencies are bouncing here. We said Aussie had a nice bounce today. Euro has an okay bounce today. Let's check New Zealand. New Zealand, a feeble bounce today, but it's green, right? Dollar Canada, very little change here. Very little change here. Dollar yen. Dollar yen. The yen is getting stronger here. So really, in most cases, the currency other than the dollar, the currency against the dollar is getting stronger. In the yen, it's getting very stronger, very much stronger. But what about the pound? The pound's left behind here, which it's just nobody wants to touch it, it seems. And it's beginning to look more and more like maybe it just wants to go lower. Is a term that you hear used. It just displays all the tendency that traders just don't want to buy it. It's not going up. Why? Why is it not going up? It's not going up because nobody wants to buy it. If they don't want to buy it while they're buying all the other ones and selling the dollar, then what's going to happen when the dollar exhibits strength? When the dollar exhibits strength, this thing's going to get crushed. Let's go to the hourly. So the theory is to sell strength on the pound if and when it occurs. Let's go, TradeStation. Come on. Somebody, I'm going to pour some coffee down into the TradeStation here. Just a second. I'm not expecting to see an overbought or oversold reading. It's been very quiet. Just kind of drifting here. This oversold reading, nothing happened. It didn't bounce. It didn't go up. It didn't go down. Richard says, have you excluded TradeStation from your virus checker? Well, it's not that, I don't think. Like this particular computer, I use it for almost nothing other than TradeStation and a few other platforms. I've used it for virtually nothing else. So I don't think I don't know if that's what it is. So let's just I just think TradeStation, it's just this particular time of day. TradeStation gets, I think the whole world is looking at their charts this time of morning in the US because the stock market's about to open in 1 hour. Other times of day, there's no issue. All right, here we go. So yeah, there's no advantage or disadvantage at this point I need to see a little bit of a rally here to sell short. Now, it doesn't have to be overbought, oversold. It could be support resistance. For example, right, you can see on the hourly that there are levels of support and resistance here. Now, I'm going to leave these lines on because these lines refer to levels of support and resistance from the daily chart. But there are also hourly support and resistance levels here too. Now, the daily support and resistance levels are still valid, but a rally up to 131 would hit a daily resistance level and would also come into contact with this for this now broken trend line. So I think a rally up to 131 would probably fit the bill for a short on cable. I just don't know if it's going to get there at this point. Maybe if we saw some serious dollar weakness. That looks an awful lot like a head and shoulders too, right? Left, head, right on the hourly, does it not? Looks an awful lot like a head and shoulders on the hourly cable right here. So a rally up to 131 would play into that as well. So I think a rally up to 131 looks shortable on British pound US dollar currency pair. That's something I would keep an eye on at this point. Back to the daily here. It's been a long, long road. And of course, this is like sort of a never-ending soap opera with the pound and the euro. We'll take a look at that pair as well. Now that's a very strong trend. The euro definitely overpowering the pound at this point. There's nothing you can do here other than go long. But it doesn't neatly fit into some moving average. Sometimes your trends sail up a moving average quite nicely. This one does not. You can see that this trend has a very different look to it. But you could certainly look at the 60-minute and buy dips on the 60-minute. That might be the best way to go for euro pound. In other words, buy the dips on the 60, either to support, look at this thing go. Boy, almost looks like a Bitcoin chart at this point. It's overbought right now. There's no way I would short it just because it's overbought. But I would hope for an oversold within this uptrend. That hasn't happened in nearly a month, this oversold RSI. So it's going to need a bit of a dip here to get me to an oversold area. So just to review, euro pound, I would like to see oversold on the hourly. Pound dollar, I would like to see overbought on the hourly. Right? And neither of these are conforming to that type of moving average strategy. Not every trend neatly conforms to that type of pattern, unfortunately. 8:29 a.m. in New York City. So a quick peek at our FX Street calendar. tells us that there's nothing hitting the tape, nothing hitting the wires. Normally, this is the time of day when information hits, but it's going to be a quiet day for data today. That's fine. We don't need a constant flow of information, but when we do get information, this is the time of day that we normally get it. Nobody really cares about the Red Book Index or the JOLTS job openings. This is stuff that nobody really follows, so we won't worry about it. The only thing on here that really is of interest, in my opinion, is the API weekly crude oil inventory. But that's 8 hours away. And if you happen to be in the Australian dollar, you would be concerned about Reserve Bank of Australia Governor Kent giving a speech 10 hours out from now. There you go. That's the only thing. That's the only thing on the docket to be of any concern. If you're in Aussie, there's a bunch of stuff coming out overnight to keep an eye on. Right. CPI, PPI out of China could move Aussie. And you've got some consumer confidence numbers, home loans, etc., out of Australia. That's it. Okay, so nothing really serious coming up on out of data-wise. We'll get back to the charts here. Yesterday we were saying that technically speaking, the dollar could be, the dollar index could be in a position to bounce. I'm going to show you the weekly. First of all, this is pretty big support. I'm going to put this right at 93. Look at that. 2 bounces from 93 in 2015, 2 bounces from 93 in 2016. Guess where we are right now? We just hit 93 yesterday, and we're hovering around 93 right now. We've had a series of lower highs and lower lows. This really peaked at the start of the year. Right after the U.S. election, the dollar really took off, hit the highest level since 2003, and it's been all downhill ever since as the market really comes to realize that a lot of the things that looked so hopeful in terms of legislation just do not look like they're going to happen right now. And so the dollar fades and has given back. This is where the election happens right here, this long wick. And all those gains disappeared and then some. But now you're at support, and now you're oversold on RSI, on weekly RSI on the dollar index for the first time since when? How long do you think it's been since we've been oversold on the weekly RSI on the dollar index? How about since 2011? Right here. That's the last time that your weekly dollar index was oversold. Right? Hard to believe. And that's where we stand, right? So if there's going to be a dollar bounce, and I don't know, I'm not going to pretend to know if there's going to be a dollar bounce, then now would be a good time. And you might think, well, Ed, why did you buy euro against USD if you think there's a chance there's going to be a dollar bounce? Well, part of using that buying on the moving average system is not to overthink, right? Not to overthink what you're doing. But at the same time, I'm long euro USD. That's another reason why it might be appealing to short pound USD, just in case the dollar does strengthen then I could be long dollars against a currency that's really weak. That's also appealing. So as a hedge, think of it as a hedge. So that's why I was kind of kicking that idea around after class yesterday. So actually, sometimes I get good ideas from you folks. It does happen, right? And did the Affordable Care Act increase health insurance premiums? Yeah, they've gone up quite a bit, and so it's a double-edged sword. I mean, healthcare coverage is a lot of people have coverage now that didn't have it before, and even folks who did have it before, it was kind of ambiguous. A lot of the coverage was, I'm going to say, was kind of ambiguous, but the premiums go up seemingly on a constant basis, and it's unsustainable. You can see how it's going to collapse. Different insurers keep pulling out. Like they just say, because insurers can opt out of it, and there literally are places now where there are just one insurer, where like one insurer has a monopoly. And I think one of the big errors that was made is that they cannot compete across state lines. We have 50 states here in the U.S., and the insurers cannot compete with each other across state lines. And I think that was a big mistake, and I think that's one of the things that needs to be fixed. But yeah, it's a huge problem. Is that the premiums skyrocket? They go up 20% a year in some places. And that's not being factored into CPI and PPI. And I think, a lot of the optimism, but at the same time, a lot of people who didn't have coverage before have it now. It's a weird situation. I mean, you could have lost everything. A catastrophic illness could have wiped you out before. And now that's unlikely to happen to anyone, really, So that's good. But then there's the bad side, is that the premiums are skyrocketing to the point where they're unsustainable. So it's broken. It's a broken system, but I don't know if it can be fixed, or it just needs to go back to the drawing board. That's for somebody way smarter than me. Okay. All right. That's gonna wrap up this session. Could it be fixed with cross-state competition? I think it would help. Because you have some areas where there's only one. You see, when different providers opt out, you might have only one provider left in a state, or in a certain part of a state is only now covered by one provider. So there's no competition in an area. So now that provider, let's say, wants to raise their premiums by 46%, and there's no other provider, and according to the law, you have to have this coverage. You have no option. So yeah, it's a flaw. It's a pretty bad flaw, and it's really kind of inexplicable, actually, how that mistake could have been made. So anyway, but that's just one aspect of it. There's a lot of different problems. All right. So anyway, look, we've got to end this session so we can start the next one. I'll be back in a little over 20 minutes with our next session. So be sure to stick around. This is Ed Ponsi for FX Street. I want to say thanks for listening, and I'll see you again in a little over 20 minutes from now.